Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Wednesday, Hump Day. It's Wednesday, October 30th. We do got a few important data to go over today, so we'll start off with the ADP numbers. This is the numbers at the ADP from the private sector. Usually towards this time of the month, we'll get the ADP, and then we got the jobless claims every Thursday, and then Friday will be the Bureau of Labor Statistics, which happens to be for the month of October. Now, September's numbers here for ADP was actually revised about 42,000 lower than what it was. So last month it came in at 135,000, and it was revised down to 100, or sorry, down to 93,000. And this month in October it came in at 125,000. So it looks like it went up, but in actuality we went down a little bit. So this is something, of course, we'll keep our eyes on. We are watching the employment numbers as that is a nice precursor towards a possible recession, because typically what will happen is the jobless claims will start rising a bit. We'll see the unemployment rate start rising a bit. That means people are getting laid off. We're starting to see a slowdown in the growth of jobs. So this is something. These are just signs that we're kind of watching here. Now, also to touch on the recession, not to scare you guys, but recession is a slowdown in the economy, but and housing, because I'm talking more about housing areas here, because with the interest rates, housing doesn't always get affected by that in a negative way. Yes, we had the crash that happened in 2008. That was a big one that's fresh on people's minds. But if you go before that, 2001, it actually took off quite a bit. The last five recessions we had, only two of them housing went down, and of course the big one was in 2008. Uh, we had a couple other ones prior, but housing still rose in that process. So don't let the media scare you in terms of housing and stuff like that, home appreciations and sales and stuff like that. We actually did quite well during those time periods, and we expect this to continue. Not a hot market, but a what we call a Goldilocks market, and that means not too hot, not too cold. Now, to kind of move on here, we got the GDP for the third quarter. There's the first view we get to see here. So we were starting off at 2% on an annualized pace. Forecast was supposed to dip because of all the situations with the tariffs and everything, down to 1.6. It did slightly dip down to 1.9%, so this is better than what we were expecting. So obviously it's a decent news. Not great news, but because of where we're at, what we were expecting, it's not bad news here. Now, later today, about 11 o'clock a.m., the Fed will give their announcement for wrapping up their uh, two-day meeting. That's 11 o'clock Pacific Standard Time, and 11:30, Chairman Powell will be giving his press conference to there. So they will be listened to very carefully. They are widely expected, about 95% chance that they will go with their third rate hike, or third rate cut, excuse me, this year. Now, a lot of people, a lot of economists think they're going to be a little more hawkish this time around, figuring this will be done for the year, and then they'll look to see if there's anything planned for next year. Because of the talk, the progress being with China, with the trade negotiations and everything, uh, that maybe they'll probably hold off, because obviously if we do go into recession, they need something, some ammunition to be able to try to help bolster. And if they just give everything away now, then it kind of takes away any power we might have later than they may have later on. So this is something they're going to probably announce. It may, stocks may not like it as much, because this is kind of fueling their rally in the new highs that they're getting, especially on the S&P. But just pay, so just be careful if you're out there. Right now, stocks are mixed. They've been kind of going back and forth. All three indexes have been going back and forth in terms of positive, negative. So we'll sometimes see them all negative, and sometimes we'll see one or two trickle into positive. They're kind of going back and forth right now. They did all start off in slightly positive, and again, they've been both tipping their toes on both sides of the line there. We do got Q3 corporate earnings. Nothing new right there. Things are coming a little bit better than expected, but of course we got to say the expectations are lower due to the slowdown in the economy, slowing down the data coming in from the manufacturing services. The trade negotiations have been kind of slowing things down. So again, that's to be expected. But the stock market has been kind of taking up a bit as a result of that, with those lower expectations. So let's see how this is playing on the bond market. Bond market is up about 16 basis points. It's going up against its 100-day moving average. So we do got better rates. Rate pricing for interest rates are a little bit better today. We'll see if we could break above this. It'll be nice, but again, it could be a knee-jerk reaction. Now, the big thing about today's FOMC meeting, something to take away from there, if there's anything inflationary in there, anything that talks about inflationary, you can see mortgage rates rise. So the bond market could drop as a result of it, because the biggest enemy to bonds is inflation. So if there's any talk that possibly there could be some inflation, you could see the adverse reaction in mortgage rates. So mortgage rates don't always follow Fed funds rates. So when the Fed is cutting rates, it doesn't always happen that we also our rates lower. Many times will go the opposite direction and go up because the concern of inflation. So let's kind of move on here. Yields have dropped a little bit down. It's fighting to stay above its 100-day moving average, and it's right about the 181, just a hair under that 181 level right now. So it's, again, trying to stay above its 100-day moving average, and it's also facing a possible drop to the Fibonacci, which the next level will be Fibonacci. All right, so rates a little bit better this morning so far, but again, I would have a finger on the lock button if you guys are in any transaction have not yet locked, just to be on the safe side, primarily because we need to see what the Fed says. If they again say anything that could be inflationary, we could have adverse reaction and the mortgage rates could quickly turn the opposite direction. All right, so that's pretty much a wrap for the day. If you guys are out there looking to refinance or buy in California, I'm licensed in California as a loan officer and would love to be able to help you guys out. Go ahead and direct message me or email me. Email me is probably the best of the two. We got a lot of solutions out there, a lot of programs to help out a lot of people, and love to be able to work with you guys. You guys have a great rest of your day. Thanks so much for watching. We'll look forward to see you guys tomorrow. Bye-bye.